Season 5, Episode 2: Income, Growth, and Hybrid Assets. If asset classes are not the most useful way to understand investments, then what is? A helpful starting point is to look at the behavior of the cash flow. What does the underlying economic activity actually do with the money it produces? When we look at investments through that lens, most of them fall into one of three broad patterns. Some assets primarily grow, some primarily produce income, and some do both: growth, income, and hybrid. Three simple behaviors that appear again and again across the investing world. Let's begin with growth. A growth asset is one where most of the cash generated by the underlying business is reinvested rather than distributed. Instead of sending money back to owners, the business uses its earnings to expand. It might open new locations, develop new products, build new infrastructure, or acquire other companies. The expectation is that these reinvestments will increase the value of the business over time. Owners benefit not through immediate income, but through the compounding of the enterprise itself. Many younger companies behave this way. They operate in industries where opportunities for expansion are abundant, and reinvesting profits can generate attractive returns. For the investor, owning a growth asset often requires patience. Income may be minimal or non-existent for long periods of time. The reward comes from the gradual increase in the value of the business. Now consider the opposite pattern. Some assets are designed primarily to produce income. Instead of reinvesting most of their earnings, these businesses distribute a large portion of their cash flow to owners. The underlying operations may still grow modestly, but expansion is no longer the central objective. The business has reached a stage where its infrastructure is largely built. It produces steady cash flow, and that cash flow can be shared. Utility companies often behave this way. So do many pipeline operators, real estate investment trusts, and mature consumer businesses. In these cases, the investment behaves less like a compounding machine and more like a cash flow engine. Income arrives regularly. The value of the investment may still fluctuate in the market, but the primary benefit to the owner is the steady distribution of cash. Then there is the third category: hybrid assets. These investments combine elements of both growth and income. Part of the cash flow is reinvested to expand the business, while another portion is distributed to owners. Many companies operate this way. They maintain the ability to grow while also returning capital through dividends or other distributions. For investors, hybrid assets often offer a balance. They provide some current income while still allowing the underlying business to compound over time. These three behaviors, growth, income, and hybrid, appear across almost every investment category. A stock can be a growth asset. Another stock can be an income asset. A third can behave as a hybrid. Real estate can follow the same patterns. A property in a rapidly developing area may function as a growth asset, relying mostly on appreciation. A stabilized rental property may behave as an income asset, generating steady rent. Another property may combine moderate appreciation with regular income. Even infrastructure, royalties, and private businesses often fall somewhere along this same spectrum. The category does not determine the behavior. The economic structure of the asset does. Understanding this distinction is important because investors often misunderstand what they own. Someone may believe they are investing for income, while most of their portfolio consists of assets that primarily depend on appreciation. Another investor may believe they are pursuing growth, while holding assets that distribute most of their cash flow rather than reinvesting it. When expectations and behavior don't match, confusion often follows. But once the underlying behavior becomes clear, many investment decisions become easier to understand. Instead of asking whether an investment belongs to a particular category, we can ask a simpler question: is this asset primarily designed to grow, to produce income, or to do both? That small shift in perspective brings clarity, and it prepares us for the next step in understanding how capital behaves. Because beyond the behavior of the cash flow, every asset also carries a different balance of something else: liquidity, control, and the amount of time required from the owner. And those trade-offs will shape the role each investment can play inside a financial system. That's what we'll explore next.